March 2020. The stock market is in free fall. The S&P 500 loses a third of its value in 3 weeks. Credit markets seize. Companies that borrowed billions to stay operational suddenly can't roll over debt. Lenders who funded operations for decades stop answering calls. The entire short-term credit system, the financial plumbing that keeps corporations, banks, and governments liquid, grinds to a halt. This is the dash for cash. Everyone wants dollars. No one wants risk. And in that moment of pure market terror, the Federal Reserve does what it was designed to do. It floods the system with money. Not slowly, not through careful deliberation. Instantly. Within days, the Fed's balance sheet expands by trillions. Bank reserve accounts, the safest, most liquid asset on Earth, swell to levels never seen outside of war or total collapse. By late 2020, the Fed is holding $2.7 trillion in reserves. That figure represents 15% of the entire U.S. economy. It's not a loan in the traditional sense. It's a structural shift in how the banking system operates, and it changes everything about risk, reward, and who pays when things break. This isn't the first time. The playbook was written in 2008, refined in the years after, and deployed again with even greater force in 2020. The pattern is clear. When markets panic, the central bank steps in with unlimited liquidity to prevent collapse. But each intervention makes the next crisis more inevitable. And the $2.7 trillion trigger isn't just a response to COVID-19. It's the institutionalization of a system where failure is no longer allowed, at least not for the institutions big enough to threaten the whole structure. This is the story of how that system was built, why it operates the way it does, and what it means for everyone who isn't a bank. The Federal Reserve was created in 1913 with a specific mandate: provide liquidity during panics. Before that, private financiers like J.P. Morgan organized bailouts during crises. The 1907 panic proved that model was unsustainable. Morgan was old. No single person could command the trust and resources to stabilize the system. So Congress created a central bank with the legal authority to create money. That authority is the foundation of everything that follows. When a crisis hits, the Fed doesn't need to find cash. It creates it, digitally, instantly. It buys assets, usually treasury bonds or mortgage-backed securities, and credits the seller's account with newly created reserves. Those reserves are liabilities on the Fed's balance sheet, but assets for the banks that hold them. They're considered the safest instrument in the world because they're backed by the full authority of the U.S. government. In normal times, banks hold reserves to meet regulatory requirements and settle transactions with each other. The amount fluctuates based on economic conditions and Fed policy. But in March 2020, normal ends. COVID-19 triggers a global economic shutdown. Uncertainty explodes. No one knows which companies will survive, which debts will default, which assets will hold value. So everyone tries to sell everything and hold cash. This creates a paradox. The assets being sold, corporate bonds, mortgage securities, even treasury bonds, lose value rapidly, not because they're fundamentally worthless, but because everyone is trying to sell at once. Prices collapse. Credit markets freeze. Companies that need to borrow to meet payroll or pay suppliers can't. The machine stops. The Fed's response is immediate. It cuts interest rates to zero. It announces unlimited bond purchases. It opens lending facilities to provide credit directly to corporations, municipalities, and even foreign central banks. And it begins buying assets at a pace that dwarfs anything done in 2008. Within weeks, the Fed's balance sheet, already inflated from previous crises, jumps by trillions. By the end of 2020, bank reserves peak near $2.7 trillion. This isn't emergency lending in the traditional sense. The Fed isn't making short-term loans to solvent institutions experiencing temporary liquidity problems. It's flooding the system with so much liquidity that banks hold more reserves than they need or want. The term used internally is super abundant reserves. The market is drowning in cash. This has structural consequences. Banks no longer need to manage liquidity carefully. They don't need to lend to each other in the federal funds market to meet reserve requirements. The Fed's balance sheet underpins everything. The private market for overnight credit, the mechanism that previously allocated liquidity based on trust and risk assessment, becomes irrelevant. The central bank is now the primary source of stability. This is the $2.7 trillion trigger. It's not just a number. It's a redefinition of how the financial system operates. The logic behind the Fed's intervention in 2020 was forged over a century of crisis management. The Panic of 1907 provides the template. When trust companies, shadow banks of the era, began failing, depositors panicked. Runs spread. The private banking system couldn't provide enough liquidity to stop the collapse. J.P. Morgan, using his personal fortune and social network, organized a consortium of bankers to inject capital into failing institutions. The panic subsided, but the lesson was clear. Relying on private individuals to stabilize the system was untenable. The Federal Reserve was designed to solve that problem. It would act as the lender of last resort, providing emergency credit to solvent institutions during panics. The theory, articulated by British economist Walter Bagehot in the 19th century, was simple. Lend freely during crises, but only to solvent firms against good collateral at penalty rates. This would stop panics without encouraging reckless behavior. That doctrine held for decades, but in 1998, something changed. Long-term capital management, a highly leveraged hedge fund, nearly collapsed. The fund wasn't a bank, it didn't take deposits, but it was so interconnected with major financial institutions that its failure threatened to trigger a systemic crisis. The New York Fed brokered a private sector bailout. No public money was used, but the message was sent. The Fed would intervene to prevent systemic risk, even for non-bank entities. Critics warned that this created moral hazard. If firms believed they'd be rescued, they'd take excessive risks. But the Fed's logic was clear. The alternative, allowing systemic collapse, was worse. That logic was tested again in 2008. The global financial crisis began with subprime mortgages, but spread across the entire financial system. Investment banks, insurance companies, money market funds all faced collapse. The Fed responded with unprecedented aggression. It cut rates to zero. It created emergency lending facilities for institutions that had never had access to Fed credit. And it launched quantitative easing, large-scale purchases of treasury bonds and mortgage-backed securities to inject liquidity and lower long-term interest rates. The interventions worked. The system stabilized, but they also established a new baseline. The Fed had proven it would do whatever necessary to prevent collapse, and the next time crisis struck, the playbook was ready. In 2020, the Fed reached for the same tools, but this time it moved faster and bigger. The pandemic wasn't a financial crisis in origin, but it created one instantly. The Fed deployed quantitative easing on a scale that dwarfed 2008. It opened lending facilities to a wider range of borrowers, and it coordinated with the Treasury to backstop corporate debt markets. The pattern was now undeniable. Every crisis triggered larger interventions, which created expectations of future interventions, which encouraged more risk-taking, which made the next crisis more severe. The system was trapped in a cycle where the cure, massive liquidity injections, ensured the disease would return. Financial crises aren't just about numbers. They're about people making life or death decisions under unbearable pressure. In 2008, 3 men bore the weight of preventing a second Great Depression: Ben Bernanke, Hank Paulson, and Tim Geithner. Bernanke, a former economics professor, had spent his career studying the Great Depression. He understood how bank failures cascade, how credit crunches strangle economic activity, how deflation destroys wealth. When Lehman Brothers collapsed in September 2008, Bernanke saw the historical parallel. He reportedly told Congress, "If we don't do this tomorrow, we won't have an economy on Monday." That fear, existential, immediate, drove the decisions that followed. The Troubled Asset Relief Program, the bailouts of AIG, Citigroup, and Bank of America. The interventions weren't popular. They weren't even clearly legal in some cases. But the alternative was allowing the financial system to collapse, which would have destroyed millions of jobs, trillions in wealth, and decades of economic progress. Paulson, the Treasury Secretary, came from Goldman Sachs. He understood Wall Street. He also understood politics. When he asked Congress for $700 billion to stabilize the financial system, he faced a revolt. Lawmakers didn't want to bail out the banks that caused the crisis. Paulson argued that the bailout wasn't for Wall Street. It was to prevent Main Street from suffering. The distinction was real, but unsatisfying. The banks that created the crisis would be saved. The homeowners losing their houses would not. This political paradox defined the crisis response. The Fed and Treasury had to save large institutions to prevent systemic collapse. But saving those institutions meant protecting the executives, creditors, and shareholders who had benefited from the risk-taking that caused the crisis. The moral stakes were impossible to resolve cleanly. Geithner, leading the New York Fed, managed the technical interventions. He coordinated emergency lending facilities. He negotiated with foreign central banks. He worked 18-hour days knowing that any mistake could trigger global financial catastrophe. Years later, he defended the interventions as necessary, but acknowledged the political cost. The public saw bailouts. Economists saw crisis prevention. Both were true. In 2020, Jerome Powell faced a similar choice. The pandemic wasn't a financial crisis initially, but it became one within days. Powell deployed the full arsenal immediately. He cut rates to zero. He launched quantitative easing. He opened lending facilities that went far beyond traditional Fed authority, and he did it knowing the political backlash would be severe. But Powell also understood something Bernanke learned the hard way. Speed matters. In 2008, the Fed hesitated. It let Lehman fail. The resulting panic nearly destroyed the global economy. In 2020, Powell didn't hesitate. He flooded the system with liquidity before the panic could take hold. The $2.7 trillion in reserves wasn't cautious. It was overwhelming. And it worked. But the human cost wasn't eliminated. It was redistributed. The Fed's actions stabilized Wall Street in days. Main Street took years to recover. The phrase, "too big to fail," describes a simple reality. Some institutions are so large and interconnected that their collapse would destroy the entire financial system. Therefore, regulators are forced to prevent their failure, even when that failure is deserved. This creates a moral hazard. If firms know they'll be rescued, they have every incentive to take excessive risks. Profits are privatized, losses are socialized, and the cycle repeats. The 2008 crisis proved the problem was real. Lehman Brothers failed. The panic that followed nearly destroyed the global economy. AIG, Citigroup, and Bank of America were all on the verge of collapse. The Fed and Treasury stepped in, providing hundreds of billions in emergency support. The institutions survived. Their executives mostly kept their jobs, and many kept their wealth. Joseph Cassano ran AIG Financial Products, the division that created the credit default swaps that nearly brought down the global financial system. In 2008, Cassano earned an estimated $34 million in bonuses. His net worth today is estimated at $200 million. Vikram Pandit, CEO of Citigroup, was paid $10.8 million in 2008, even as Citigroup lost nearly $20 billion. His current net worth is estimated at $120 million. Lloyd Blankfein, CEO of Goldman Sachs, took a modest salary during the crisis, but remained a billionaire. The pattern is clear. Executives who steered their firms into catastrophic failure were largely insulated from the consequences. The institutions they led were saved by public intervention. The wealth they accumulated during the boom years remained intact. Main Street faced a different reality. During the crisis, foreclosures exploded. The share of loans seriously delinquent or in foreclosure more than doubled previous record highs. Millions of families lost their homes. For most Americans, homeownership is the primary source of wealth accumulation. Losing a home doesn't just mean losing shelter, it means losing savings, stability, and economic mobility. The intervention disparity was stark. The Fed triggered $2.7 trillion in liquidity overnight to stabilize the financial system. Relief for homeowners required congressional approval, took years to implement, and was far smaller in scale. The Homeowner Affordability and Stability Plan, launched after 2008, helped some borrowers modify loan terms, but it didn't stop the wave of foreclosures. The Homeowner Assistance Fund, launched after COVID-19, followed a similar pattern: slow, conditional, and politically complex. The fundamental asymmetry is built into the system. The Fed has legal authority to provide unlimited liquidity to financial institutions. It does not have authority to provide direct relief to individuals. That requires Congress, which means political debate, partisan gridlock, and delay. So when crisis strikes, Wall Street gets immediate, unlimited support. Main Street gets whatever Congress can agree on months or years later. This isn't a conspiracy, it's a structural feature of how the system operates. The long-term consequences are measured in inequality. Massive liquidity injections inflate asset prices. Stocks, bonds, and real estate all rise. People who own assets get richer. People who don't, who rely on wages and savings, see their purchasing power eroded by inflation. The Fed's interventions, necessary to prevent collapse, systematically advantage capital over labor. This creates a political problem. The public sees bailouts for the rich and austerity for everyone else. Trust in institutions erodes. Populist movements gain strength, and the legitimacy of the entire system is called into question. The $2.7 trillion trigger is part of this pattern. It stabilized the financial system. It prevented collapse, but it also reinforced the structure where concentrated financial power is protected at public expense. In May 2020, Jerome Powell made a statement that defined the Fed's role during the pandemic. The Fed has lending powers, not spending powers. This distinction is legal, political, and philosophical. The Fed can lend money against collateral to solvent institutions. It cannot provide capital directly. It cannot forgive debt. It cannot decide which firms should survive based on social or political criteria. Those decisions belong to elected officials. This boundary protects the Fed's independence. Central banks are most effective when they operate free from political pressure. If the Fed were directly allocating capital, deciding which industries to support and which to let fail, it would become a political target. Its independence would erode, and its ability to respond quickly during crises would be compromised. But in practice, the boundary is blurry. When the Fed provides massive liquidity, it prevents asset prices from collapsing. That prevents institutions from becoming insolvent. So even though the Fed is technically only providing liquidity, it's effectively preserving capital. Take 2008. The Fed lent hundreds of billions to major banks. That lending prevented fire sales, desperate asset sales at depressed prices that would have wiped out capital. By providing liquidity, the Fed allowed banks to hold assets until markets stabilized. This preserved the bank's solvency. The intervention was technically lending, but the effect was a quasi-capital injection. This technical mechanism becomes a political strategy. The Fed can act immediately to stabilize the system while avoiding the full public debate required for direct spending. It uses its independence to solve immediate crises without waiting for congressional approval. But this creates a democratic deficit. An unelected body is making decisions that have profound distributional consequences. Who gets liquidity? At what cost? Who bears the risk if the borrower defaults? These are fundamentally political questions. Yet they're answered by technocrats operating under emergency authorities designed for temporary crises, not permanent structural support. The $2.7 trillion in reserves represents this tension. The Fed created that money to prevent collapse. It succeeded. But the decision to do so and the scale at which it was done reshaped the financial system in ways that go far beyond temporary liquidity provision. And because the Fed operates independently, those decisions were made without direct democratic input. This isn't necessarily wrong. Speed matters during crises. Democratic deliberation is slow. If the Fed had waited for congressional approval before acting in March 2020, the financial system might have collapsed before help arrived. But the trade-off is real. The system sacrifices democratic accountability for effectiveness. And over time, as crises become more frequent and interventions more massive, that trade-off becomes harder to justify. The most troubling aspect of the $2.7 trillion trigger isn't what it did, it's what it guarantees will happen next. Every major intervention creates expectations. Markets learn that the Fed will step in during crises. Investors price in that implicit guarantee. Risk premiums fall, leverage increases, and the system becomes more fragile, not less. This is the ratchet effect. Each intervention raises the baseline for what's needed next time. In 1998, the Fed brokered a private sector rescue of long-term capital management. No public money was committed, but the message was sent. Systemically important failures won't be allowed. In 2008, the intervention was far larger. The Fed cut rates to zero, launched quantitative easing, and created emergency lending facilities. The financial system stabilized. But the precedent was set. When things break, the Fed will deploy unlimited resources. In 2020, the Fed moved even faster and bigger. It used the same tools as 2008, but at greater scale and speed, and it expanded its reach, providing support to entities that would never have qualified for Fed assistance in previous crises. Each step made logical sense in isolation, but together they created a system where failure is no longer tolerated. And that creates a paradox. Preventing failure encourages risk-taking, which makes failure more likely, which requires even larger interventions to prevent. The evidence is visible in leverage ratios. Between 1997 and 2007, American banks tripled their leverage, the ratio of assets to capital. That made them more vulnerable to losses, but it also made them more profitable during good times. And because banks believed they'd be rescued during bad times, the risk seemed manageable. Regulatory reforms after 2008 tried to address this. Banks were required to hold more capital. Leverage limits were imposed. Stress tests became routine. But the fundamental moral hazard remained. As long as the Fed stands ready to provide unlimited liquidity, the incentive to take excessive risk persists. The $2.7 trillion in reserves is both a solution and a problem. It prevented collapse in 2020, but it also ensured that when the next crisis hits, markets will expect an even larger response. And if the Fed can't deliver, if $2.7 trillion isn't enough, the panic will be worse than if no safety net existed at all. This creates a structural trap. The Fed can't credibly commit to letting large institutions fail. Markets know this, so they price assets accordingly. And the system becomes dependent on continuous intervention just to maintain stability. The long-term consequence is a financial system that can't survive without central bank support. Private market discipline erodes. Risk management becomes theater. And the entire structure rests on the assumption that the Fed will always be there, with unlimited resources ready to prevent collapse. That assumption has held so far, but it's not guaranteed to hold forever. The $2.7 trillion trigger isn't just a response to COVID-19. It's the culmination of decades of crisis management that has fundamentally reshaped how the financial system operates. Before 2008, market discipline mattered. Firms that took excessive risks could fail. Creditors could lose money. Shareholders could be wiped out. That threat imposed discipline. It made risk expensive. It encouraged caution. After 2008, and especially after 2020, That discipline is largely gone. The implicit guarantee is now explicit. Large, interconnected institutions will be rescued. The only question is how quickly and on what terms. This has distributional consequences. The protection extends to capital, not labor. Banks get liquidity. Homeowners get foreclosure. Shareholders get bailouts. Workers get unemployment. It also has political consequences. The public sees a system rigged in favor of the wealthy. Trust erodes. Populist movements gain strength. And the social contract that underpins democratic capitalism frays. The technical justification for intervention is sound. Allowing systemic institutions to fail would cause catastrophic economic damage. Millions would lose jobs. Savings would evaporate. The Great Depression proved that letting the financial system collapse is worse than any bailout. But the moral justification is harder to sustain. When the people who caused the crisis keep their wealth, while the people who suffered from it lose their homes, the system looks less like necessary crisis management and more like class warfare. The Fed's defenders argue that its interventions prevented even worse outcomes. That's true. But it's also true that those interventions preserved a system that generates crises with increasing frequency and severity. The $2.7 trillion trigger worked. The financial system stabilized. Markets recovered. The economy, after a brutal initial shock, began to grow again. But the cost was paid in moral hazard, structural fragility, and political legitimacy. And the next time crisis strikes, and there will be a next time, the Fed will face the same choice: intervene with even greater force, or allow the collapse it was created to prevent. History suggests which choice it will make, and history also suggests that each intervention, while preventing immediate collapse, makes the eventual reckoning more severe. The system we've built is one where failure is impossible until it isn't, where risk is socialized while profits remain private, where democratic accountability is sacrificed for technocratic efficiency, and where the gap between Wall Street and Main Street grows wider with every crisis. The $2.7 trillion trigger is part of that system. It's not an aberration. It's the logical conclusion of a century of crisis management. And understanding it means understanding not just how money moves, but what it means for everyone who isn't a bank.